Here's an episode of Taxes and Bourbon. All right, I got my horse soldier bourbon here today. Let me make sure we're streaming.
Oh, you got horse soldier. Nice.
Yeah, I still been dripping.
Never heard of that. That sounds ridiculous.
Well, a guy named Mike had sent it to us. I gotta see what's going on here. Make sure we're level.
I'm drinking Four Roses single, actually small batch select today.
I've got this guy, Old Forester, the first bottled bourbon.
Okay, hold on, I'm about to use the add everyone feature.
It's pretty good.
All right.
Okay, so you guys ready for the blowback?
The blow to add everyone. Welcome.
Okay.
All right, what are we doing today, guys?
We are gonna have a little chat about what's going on in the world of tax smart investors, and then we can kind of dive into a little talk about the most recent episode we did on the Tax Smart Investors podcast regarding average period customer use, and then we can take some questions from the live studio audience.
Also, Tom, it sounds like you're using your camera mic right now.
Am I?
It's very
Let me see. Oh, I am. That's horrible.
It'd be my default mic.
Oh, there you
that's much better. There
That's
you go.
way
Okay.
better.
We're back with a good thing. So where do we want to start? Okay, so Tax Smart Insiders, right? So anybody who's not familiar with our Tax Smart Insiders community, it's our private community where you get access to us fine gentlemen here on this live Q&A today.
You're here.
And yep, cheers. And we recently released a very cool new feature that allows you to tap into our brains 24/7 to get answers to your tax questions, and it's been phenomenal. I'm not going to tell you exactly what it is, but I'll just tell you that everybody who's touched it so far has had a lot of fun with it, and it is quite a powerful tool. So
We should put like Easter eggs in there too. Like
it's
know.
yeah, if you're paying attention.
yeah. What's Brandon or what's Justin's favorite dad joke? And then he like spits it out. Yeah. Anyway, you should, if you're an insider, if you're in our Tech Smart Insiders, you know what we're talking about. So it's a very cool thing that Tom spun up there.
To be whichever one makes the kids go cringe, whatever that means.
the dad jokes.
Yeah, the dad jokes. I was saying, like we should put like funny or unique things about each person and see what people can find. It's like a game,
Well, we could do that. We might just do that soon. So if you want to check that out, you can check that out by signing up for a free trial to our Tax Smart Insiders community. You know what? Because you joined us here today on this Taxes and Bourbon, I'm going to give you a special gift. You get the STR tax course for free. The course has helped over 600 investors understand and use the STR loophole. You can get that by going to www.taxsmartinvestors.com/STR free course. Again, that's www.taxsmartinvestors.com/STR free course. So go ahead and grab that if you have not already. But it's really interesting. When Brandon was out of office, we actually recorded an episode on the Tax Smart REI podcast covering the average period of customer use and how to calculate that on a multi-unit building. And it was a very interesting conversation. Justin, will you have any takeaways from that episode?
Yeah. I mean, it's a little bit tricky, and I think that a lot of investors would, it like makes sense from just kind of like hedging your bet sort of, situation, because I understand from an investment prowess of wanting to be able to throw a long-term tenant on one side of a duplex and then short-term rental the other side out, because you could hopefully be, like I said, hedging your bet where you've got like, okay, my long-term tenant's kind of hopefully covering most of the mortgage, and then I'm like generating this basically all the profit maybe on the short-term rental side. But it can be detrimental if your goal with that property is trying to hit that short-term rental exception or loophole.
Yeah, no, for sure. I think that cleared up a lot of misconceptions out there for how how people calculate the average period of customer use on a multi-unit building, and it's not just on a unit versus unit basis. You can't just take unit A as a long-term rental and unit B as a short-term rental and treat them as such. There's actually a calculation that you have to take. They have to go through to determine the average period of customer use between both units. So you can find more about that by listening to the Tax Smart REI podcast. But one of the things I found really interesting about that episode was what Justin found out about the average period of customer use when it spans when a customer uses it over a multiple year period. And that was really interesting because what we basically found was that when you use a property over a, say, 2-year period, you don't calculate the average period of customer use just for the 365-day calendar year, but you have to calculate the average period of customer use over the entire period. So if you have a period of customer use that goes 2 years, you have to count that entire period, which could be more than 365 days, which is really interesting.
Mm-hmm. Yeah, and I think like the scenario that we'd run into just the most often would be, if you have something like an extended stay that's 20, 30 days long or something like that spans the end of the year. We've got a decent amount of questions about that, I'd say, over the years, where it was like, hey, for some reason somebody winds up wanting to book my place from December 15th to January 15th. Like, how am I supposed to handle that? The Treasury regulations have some prickly verbiage that are buried way down deep in there that essentially says that you've got to count it as a 30-day stay, in that scenario like that, where it's crossing over the end of the year.
Yeah, very interesting stuff.
Definitely could be, that isn't necessarily like going to completely blow your strategy 100% of the time, but if you're somebody that's maybe placing a property in service in like the fourth quarter, it could make a pretty material kind of impact on your average stay calculation. If you were thinking, I'll only have to count, this is 15 days in the calendar year, it could be rough if you were having to count it as a 30-day stay instead, and it winds up pushing your average stay calc way up.
I've got a question off topic. Can we go off topic?
Oh, that's like the name of the game.
Yeah. That's why I wanted to just clarify before. Yeah, go ahead.
All right, real quick. So we're going to be taking questions. So if you're on this live, go ahead and hit that like button. Help get this out to more people who are on the Tax Smart Insiders Facebook group. Also, drop your questions in the comment section. All right, and we're going to be taking questions in a few minutes. So I just wanted to drop that. Brandon, back to you.
What's up, Gordon? Thanks for hitting us up. And thanks for watching today. Appreciate that. So I was on a webinar earlier this week. I showed up 2 minutes late, man. It was not good. It's just, I have like a terrible habit of always showing up anywhere between like 30 seconds to 120 seconds late every single time. So yeah, so 2 minutes late to this webinar, I was like, I'm so sorry. Anyway, it was a great webinar. Absolutely crushed it. But one person was asking about short-term rentals on Schedule C versus Schedule E. So I wanted to throw that out there to you, very fine and smart gentlemen. When does a short-term rental go on Schedule C versus Schedule E? And the question was like, the Treasury regulations to Section 469 say that if it's less than a 7-day average period of customer use, then it's not a rental activity. Right. Thus, it must go on Schedule C. And so I kind of explained, but I would love to hear your takes on that.
Yeah, so let me just jump in because I've been getting that question asked a lot recently, and we put out resources within the Tax Smart Insiders community on detailing exactly why what I'm about to say is the way it is. But basically, IRS Publication 334 and IRS Publication 527 very clearly state that if you are providing substantial services such as that fine and hotel, like daily cleaning, daily meals, that type of stuff, then it would generally be reported on Schedule C, right? But then if you look at the regulations, I think I don't remember the exact regulations on the top of my head, but it's basically it's not subject to self-employment tax unless you are providing substantial services or services rather for primarily for the convenience of your of your guests above and beyond what would normally be provided in connection with the rental of space, right? Basically what I was saying, the occupancy of space. So that's kind of my take on it.
Yeah, and that like, you know, to people that aren't super familiar with all the tax forms, like that tangentially is also confirming what Tom was saying at the beginning there, because Schedule C activities are subject to self-employment taxes. Schedule E activities are not. So the code section that is addressing self-employment tax, when it's saying that the rental activities are not subject to self-employment tax, like that's what it's pointing at. The other thing, and I know this is like, we prefer to look at stuff like, you know, the code section, treasury regulations for supporting all this stuff, which we always do. But I get the question fairly often too, where somebody says like, "Hey, my tax preparer just still doesn't agree," or they're like, you know, is there any way that like I'm worried if I try to take this to them, I'm not going to be able to cite that treasury regulation, you know, or that those publications or something like that. I'm worried something's going to get lost in translation. Is there like anything else that I can at least like tell them, hey, like this is this is some more like easy proof or whatnot as to like why it's supposed to be on Schedule E. And I actually did this at my local RIA meeting last January. I did like a little brief presentation, and somebody had questions on this. If you look at the Schedule E itself, about a quarter of the way down the page, there's these little code numbers, just 1 through 8, and we have to put on there basically, okay, here's the rental property. It's a single family, it's a multifamily, it's a commercial property. We have to identify it with one of those numbers. And you'll find that one of those on there, I think it's number 3, is vacation rental. So, I mean, it's quite literally on the Schedule E form right there. So it almost, you know, you could say to like a tax preparer that's saying like, no, we got to put this on Schedule E. You could say like, well, then why do they have a vacation rental code specifically on the rental tax form? So I like that right there, I think is at least like it's very on the surface, you know.
Yeah, no, you guys are all on the same page, which is good because we all work at the same firm. So hopefully we're all on the same page. But what I told the webinar was, I said section 1202 is the self-employment section, and then I was like, wait a second, section 1202 stock. That's the $10 million capital gain exclusion. Like, what did I just say? And then I was like, wait, hold on. I said the wrong section. When I looked it up, it's like, oh, it's section 1402. 1402. So I showed up 2 minutes late to this thing and then threw out the wrong code section. I felt like such a dummy. But yeah, it's section 1402. So my take on it is it's Schedule E because section 1402 is a self-employment section, and that excludes rents from rental real estate. And then you could say, well, it's not rental real estate because section 469 says it's not rental real estate, but section 469 and 1402 don't cross-reference each other. So you have to look at them separately. So section 1402 would look at most short-term rentals as rents from rental real estate, and therefore exclude them from the definition of self-employment. So if you have income that's excluded from the definition of self-employment, you wouldn't report it on Schedule C because that's going to subject it to self-employment taxes. So that's like our roundabout way of kind of explaining it should be on Schedule E 9 times out of 10, probably 95 times out of 100. But if you provide substantial services, that's where it goes on Schedule C, kind of like what Tom was saying. So
yeah, I mean, in the worst case scenario, right? What I think I think someone might have said this at one point, was like, you know, even if that was not correct, which it is, right? Even if that was not correct, like, you report it on Schedule E, what would be the difference if you report it on Schedule C? Because at that point, it's not subject to self-employment tax anyway. So it's like almost you're arguing over which form it goes. You know, you're arguing over semantics, I guess is the word I'm looking for, maybe.
Hey, I got one more thing before we jump to like the Q&A stuff that I know that you're trying to queue up. Can I share my screen?
Yeah, I think so. I believe so.
Here we go. Let's see if this works. I've never tried this on Restream, so let's just see.
Okay. By the way, if you're on YouTube right now watching this, hit the like button on YouTube too. And drop some comments too on YouTube. You could also we can also take questions from YouTube.
I think, do you have to add my screen?
Yeah, I have to add you.
There we go.
There we go.
All right, dude.
Oh!
Yeah. All right. So for those of you that don't follow me on Twitter, over the past like 3 to 4 weeks, I've been trying a new Twitter strategy, which is where my strategy is you post an engagement post, so something like an opinion or something that is relatively controversial, but not like
Yeah.
I'm not trying to be an a-hole, right? So it's just like saying something that'll get people talking. And then what I do is I post a business tip, and then I post an accounting specific tip every single day. So the idea is these engagement posts get like large amounts of engagement. It's a high total addressable market, meaning there's a lot of people that would resonate with it. So like an example of one of my engagement posts is
I just read the top of that. That was great.
yeah, we'll go back to it in a second. But like an example, one of my engagement posts is this one, right? Like lazy parenting, giving your toddlers a tablet during a meal at a restaurant to keep them occupied. At least that's what I used to think. It's funny how having your own toddlers changes your perspective. Now, what's interesting is that I never actually said here that I give my toddlers a tablet, right? I just said it changes my perspective. But people assumed that I just sit there and give my toddlers my toddlers tablets. So I got like tons of views and likes and quote tweets. Anyway, that's an example of what I'm talking about. So it's just like something that resonates with a lot of people, and then they just like go to war here in the comments and stuff. And so the reason that I'm doing it is we're hiring tax managers and tax seniors. And so I'm trying to get my name out there to get in front of more tax accountants so they can come work at the firm and serve all of you beautiful people that are watching this right now. But anyway, one of my posts went viral the other day, and I mean viral for Twitter. Notice this one's, and I wanted to share with you guys because it was a tongue-in-cheek post, but legitimate at the same time. So I said, the year's 2030. You've been handed a jail sentence for tax evasion. Your wife's divorcing you, taking what's left of your assets. Your kids are getting teased at school because daddy's a criminal, all because you downloaded TikTok. Now, this is a TikTok video, and we're going to watch it together. 4 ways taxes.
Oh, there we are.
Add wife to the corporation so you can deduct business meals. Travel with business intent. Film it. So film your tax fraud. Very important. Only use business cards. Don't use personal cards.
Excellent.
Was last one. I get whatever. Yeah. Anyway, so film it. It's just like ridiculous.
I had no idea it was that easy. Like, what are we doing here? Like,
well, I get this guy is like super popular and often posts some very sketchy things like this. But like I wanted to actually throw it to you guys and see what your takes are, because I think that all of this is not legit. Adding your wife to your business so that every meal that you have is deductible. It's like that's not how a business meal works. Filming so that you have proof, like that has nothing. Traveling with business intent isn't even a thing. It's either a business trip or it's not. Like saying that I intended it to be a business trip is a joke. And so anyway, it was great. This was a great post because I got all the tax accountants on Twitter just like piled onto it and added to the engagement and stuff. But but I wanted to get your takes on that. I mean, what do you think about adding your spouse to your corporation, or LLC or whatever? Traveling with business intent, using only business cards and not personal cards. What do you think?
Man, if divorce wasn't so expensive, I'd just get married to somebody and add them to my corporation, just swipe away every time I go on a vacation.
Jeez, dude. I don't know if that's very PC, Tom. You're not supposed to say stuff like that these days.
What do you mean? It's true. It's true. It's expensive. Believe me. It's the quickest way to go broke.
My wife's a 51%, owner on our partnership. So I don't know, what does that tell you?
No, so you deduct all your business meals then.
Yeah.
Yeah. All your meals, all your groceries.
It's right up there with like that one. Yeah. How often are you able to have an actual business meeting over lunch type of thing? I think that the logical question that would just come up is like, oh, okay, sure. Like, if I'm going to meet with another real estate investor or whatnot, or like a real estate agent to talk about like properties or listings or anything like that, it makes sense that maybe I'll do that over lunch because we're both doing things throughout the day. We have like your business going on, my business going on, and the only time we can get together is like, over lunch. So sure, it's deductible. But can you really like have that same kind of scenario being replicated with your spouse just reasonably?
So just to clarify, you don't need to take a trip to Cabo, private charter, whatever plane to have a business meeting with your spouse who's also on your LLC? Just to clarify.
Right,
No.
right.
Okay.
That's what boils back to like we've had this conversation before about like what's ordinary necessary for the business too. You know, I mean,
Yeah. Well, we got Rachel. She's like, yo, it's a family affair. It feels like my husband and I talk shop all the time. I get it. I mean, we should be able to deduct our house, you know? This entire thing is an office. It's just
I'm talking acquisitions and like tax benefits all day with like the next property we're gonna buy with my wife and stuff. And she just, you know, most of the time she's like, oh my God, I don't want to hear about this stuff anymore. Like taxes and real estate, would you knock it off? And I'm like, no, we need to write up for dinner. But yeah. Crazy.
Dude, I paid James the other day $1, my son, my 3-year-old, $1 to assist me cleaning up some branches at the rental property. So that is a number one, that's a tax deduction for me. Number two, I've got a new business partner. So everything I do with him now, all the toys, gas, car seats, I'm writing all that off now too.
Employee benefits, you know. Employee retention costs, you know.
We were driving by. He's like really into construction equipment, and we were driving by like a construction site, and he said, "Oh, a digger, or what did he say? No, maybe he's an excavator or a front loader. I don't know, one of those things." But he's like, "Oh, an excavator. I want to buy that." And I was like, "Oh, well, how much do you think it costs?" And he said $11, and I was like, "You got it, kid. That's exactly how much it costs." Yeah.
I don't know if you can get even a toy excavator for $11 these days.
That's a good point, dude. I don't know if you could go to Target and get an excavator for $11.
Yeah, that's true.
Yeah. Anyway, I wanted to show you guys that. I was like, oh, it's a big post. It went semi-viral, and it's kind of funny. So
what got me out of that post when I first saw it was the take pictures. The IRS loves evidence, and I saw in the comments to that or whatever, so many people are like, "Yeah, the IRS loves evidence. So does the prosecutor."
Yeah, exactly. Yeah, the IRS loves your evidence. Like, thanks for posting this. Yeah, I mean, you just got to be careful. Like, it's really easy to the reason that this type of marketing is so successful is because it's really easy to get sucked into this. You kind of get this FOMO, right? Like, oh my gosh, I'm not doing the things that I should be doing. And so you call them up and you pay them like 9, 10, whatever thousands of dollars to tell you all these. I don't know what they do, but if it's that type of advice, it's not good advice. And so it's just, you just got to be careful if you're looking on social media for tax advice. You know, we try to set the record straight, normally in a really nice way. I was a little mean on that one. But normally we try to set the record straight in a pretty nice way. But that's also why we invest so much time in creating content. We just want people to have good content. Like how many episodes do we have with Tax Smart REI podcast now?
I think so. Like
total, like or something, right?
So we're at like 232, like number wise, but when you add all the other podcasts that we have up that aren't numbered, I think Justin had it over 250 recently. I think that's incredible. 252 maybe.
Wow. Yeah, and we've got how many downloads did we get last month? We got 114,000 downloads last month. Amazing. 114,000 downloads last month. 98, 124 the month before that. We hit 130 January of this year. So maybe
what the heck did we talk about in January? You know, like,
I don't know.
Might have been tax season. Who knows?
Yeah, I think it's just tax season. Everybody's on holiday in December, so it always drops down. But yeah, man, I mean, you know, we invest a lot of time into really putting this out there. It's pretty cool how much it's grown, but that's why. It's because, you know, part of it is obviously marketing. We want everybody to listen to that and think that we're the smart people and come in and buy services from us. But at the same time, it's also just like, dude, there's just so much trash out there that you have to sift through. And if you're watching TikTok and Instagram and Twitter, it's hard. It's hard for a non-tax person to understand what's actually doable and what's not. So
I probably need to set up an account on there or something, because I'll have just, you know, friends that are like, oh yeah, you're the tax guy that I know or whatever, and they'll send me like, you know, they'll send me a link to a TikTok video and they're like, hey, I saw this crazy thing that somebody was posting on there. Is this actually legit? Because it sounds nuts. And they'll break it down. I'm like, no, you can't. That's definitely clickbait for sure.
All right. So we got our first question of the night. And that is, what can I write off when I'm investing long distance? That's a really interesting question. It's really broad. Can I write off a Tesla local and can I buy a Tesla local and try write off? So it's two different questions here. So when you're investing long distance, right? It depends, right? So before you acquire the property, typically you're not going to be able to write off travel and stuff like that. Before you actually acquire the property, at that point, you're gonna have to usually add it to the property's basis once you acquire it, right? So you're not gonna be able to write that off. But once you actually acquire the property, you're typically going to be able to deduct travel to the property, assuming the travel is primarily for business purposes, not just for business intent, but primarily for business purposes. You'll typically be able to deduct the airfare, the travel to and from the airport, the car rental when you get down there is, in situations where the trip is primarily for business. So that's typically what you'll be able to write off from a long-term basis. I don't know if you guys have anything you want to add there.
Yeah, I mean, I was just gonna say, like, to add to what Tom was saying at the beginning, there is that you can deduct those travel expenses before you acquire the property, but it is still worth tracking them, because once you do acquire a property like in that market, you'll be able to include them in the basis or the cost of that first property that you acquire. So, and they're not like being lost necessarily by any means there. So I was going to say, like, oh, you can't write a Tesla off, but you could write off a Cessna. But I'm just kidding. Yeah, I mean, again, it kind of boils down to like what you can reasonably justify, for like business travel expenses. I mean, when it comes to buying cars to be able to, write off in the business, what I always end up kind of circling back with a lot of clients is, is there like investment prowess there in general? Like, what is kind of like the motivation behind it? Because if you just have like one property, I would say, man, take that $90,000, $100,000, and instead of buying a vehicle, buy another rental property with it. Now, if you have like a dozen or 15 properties that are kind of within driving distance and it makes sense because you're like, I have a legitimate need, like I have a use for like an F-150 Raptor or something like that, that I need to be able to haul like my repair supplies and stuff to and from the property. Well, then now you have like more of an actual like utility for the vehicle. Because at the end of the day, I think, and I don't mean to put words in the questioner's, that's the right term, the inquirer's mouth here, but like, if your intent is to be able to like buy the vehicle and write it off for the business, and then in some form or fashion, like be able to use it personally, it's not going to benefit you very much, because all your deductions for that vehicle are going to get prorated if you do use it personally. So like, ideally, to be tax efficient, you want to be able to use the vehicle as close to 100% for business purposes as possible. So if you're just like, to simplify that scenario, if you're wanting to be able to fully maximize all the write-offs of that vehicle, you're not going to want to really use it very much personally anyways. So that's why I would circle back to like, what's the, investment prowess, investment return there.
No, well said. Well said. So for anybody who's watching this right now, I know we have some watchers on YouTube. We also have some watchers on Facebook right now, a bunch of them. Go ahead, drop your questions in the comment section. We'd love to take your questions. Brandon says, follow him on Twitter if you want to laugh. So that's at bhall CPA. Follow him on Twitter, and his posts have been really freaking funny. And I tell you, right, that one got me. I swear to God.
It's not real estate content though. So if you're like, oh, I want more real estate tax content, I'm not dishing that out. My Twitter account is literally to try to get in front of more tax accountants that are out there in the world and make them laugh and make them want to come work for our firm. Like that. That's what it is. But it's like, it's an engagement post that, I come and join in, right? Like play devil's advocate and like join in on the fun on my engagement post. But the second tier post is just a business tip, which might actually help some of you. And then the third post is a more niche accounting firm management tip. So I'm just trying to like get more in front of tax accountants out there.
It's funny, Brendan. I could see you doing like stand-up comedy on this, like, you know what I mean? Like just taking your tweets and stand-up comedy.
You honor me, but I don't know. I can do the thing where it's like some people say mean things and you like read the tweets about yourself or something. Like I because like these tweets like people just like come in and they just say mean things. I could do that. That would be funny.
Yeah, I have a really thick skin, so I need to get on there and do some of that kind of stuff because I would just love to watch the things fly.
Well, I tell you. So this has been a big unlock for me because last year I started my Twitter account. I mean, I've had my Twitter account forever, but I kind of like restarted it early 2022. And every day I would make 3 to 4 posts about running an accounting firm. And the idea was, again, to try to get in front of tax accountants. But at the time, it's more so just like other firm owners and just network and meet these people.
Sure.
And I did that through April of this year. But like the negativity just got to me, so I stopped for a while. And then when I restarted it, I like kind of like did some reading and listened to different things. When I restarted it, I was like, you know what, I'm gonna have more fun with this, and I'm gonna like post these engagement posts, which are literally intended to kind of get the hate mail going, and that's been like so freeing for me. It's been a night and day difference. Like I don't stress about it anymore, because I used to get stressed. It was like, oh man, like I worked really hard on this content and somebody doesn't like it, and it hurts, you know? And this is coming from a guy that's like created content for years and years and years. I get it. Like people don't like, you can't please everybody, but I don't know. There was just something about it where it was like really getting to me. So when I reset about a month ago and just committed to this, let's just have some fun. It's been a blast, man. It's been so much fun. And it's just so funny to watch like all these people go back and forth in the comments.
Well, before we get to Rachel's question, because I definitely want to hit, that's a really, really good question, by the way, I had this epiphany, Brandon, like we need to have the next tax and legal summit in the Bahamas or something. That way everybody has a actual business reason to go down there and attend instead
That's
of
actually not a bad idea. Tom, you went to Cancun for a conference, right?
I did. Hold on, I'm sorry. Yeah, I did. Sorry, I had the Facebook one up going too for a second. Yeah, I was in Cancun for a conference earlier this year. Amazing experience, and it was definitely business related. I can tell you that.
Yeah, business intent.
No, it was not business intent. It was we were in conferences. You know,
it was actually business, not intent. It was actually okay. Got it.
It was a business conference. It was a good time. It was a good time. I'd say, yeah, it was a good time.
Good.
And on the conference thing too, I would say like almost every one of the long-standing conferences that I've ever seen or that I've attended, a lot of times they go from like late Wednesday and they always end on like really early Saturday morning. And I think that is absolutely geared towards being able to enable people to say, I had to stay Saturday for these sessions because that was a business day. But then after I cut out for lunch at noon, spend the other half of the day doing whatever it is in New York City or San Francisco or wherever the conference is being held, to be able to satisfy that. More than half the day was being spent on business and stuff. I mean, all of them end at lunch on Saturday. And it's got to be worth tapping into that weekend sandwich rule for sure.
Yeah.
So, all right. Yeah, you want to, I don't know how you do that. How do you pop up Rachel's?
Yeah, all right, Tom. Let's go, man.
All right. Here we go.
On your host duties here. You got to keep the convo rolling.
Yeah, that one.
There we go. Okay, so Rachel's question is: happen to know any markets inherently low and depreciable basis? Any rules of thumb around that, or is it just case by case? Looking for the best bonus depreciation markets in 2023.
So
not California.
I think we should just ask, like, is anybody that's listening throw out there real quick, like, what do you think would be a market with low depreciation before we answer that question?
Also, why am I getting covered by the question right now? This is some BS.
I don't even know how to move people around.
Why is Tom's video bigger than ours, Brandon? What's that about?
It's because I don't know. It's the Restream account. Okay. So to answer Rachel's question, it's my take on this.
Looking at you guys, so like people need to see my face.
There they go. They see Brandon.
They need to see the question.
So here we go.
What's more important, Justin?
My take on that question is markets that are not high in land value, right? That's going to give you the most bonus depreciation, most likely. And those would be markets that are not California, like Brandon said, but markets I think like Memphis, Tennessee, probably places like the Midwest, Middle America will probably be the best locations in my opinion. Definitely not New York.
Definitely
Yeah,
Midwest.
And I think that's the like surprising or maybe like the ironic twist that people aren't expecting is that like okay, a New York or a California type of scenario is probably actually going to be somewhat disadvantageous to bonus appreciation. Whereas like something like the Midwest, like I'm in Missouri. Hey, anybody that's watching from the Midwest, but the driving factor on that is the land value. Like if you have a purchase price that's $300,000, but like 40% of it's in the land value, you're just frankly not going to have much in the building. But if 90% of it's in the building and you're able to allocate more of that to actual depreciable property, ultimately your cost seg results are going to wind up generating higher amounts of bonus depreciation in that situation. Because yeah, the case by case basis piece is really twofold. Like it's location because of land value, but it's also like the class of the property of how nice is the property, how amazing is the kitchen, or it's like stuff like that's going to increase bonus appreciation. So definitely like class of property, but also location and land value for sure.
I think we should clarify New York because most of New York is actually not bad. It's just New York City and Long Island that's bad.
Yeah, but nobody lives anywhere. No, I'm kidding.
What are you talking about, dude?
I live in New York.
People that live in New York. Yeah, see, you got Syracuse, Albany. You got a lot of other places.
Nobody cares about those places.
Yeah, so those other places are not nearly as bad. I think they're actually more like normalized. But yeah, I mean, North Carolina, South Carolina, Georgia, Florida, the Midwest states, Alabama. I mean, all those are really low land values comparatively. I mean, you're talking like 10, 15, 20% is land value. I think you get Texas, they make all their money on property taxes. So they're very, very particular about valuations. Virginia is like kind of mid-range. Washington, D.C. is on the high range. So anytime you're going to be around a city, a major city, it's going to be a higher value areas. Yeah, you move out to the rural areas and you're good. I think that's true about California. California is pretty much across the board higher, but even so in California, like, San Francisco is like 80-90% is land value. What are you doing over here, man? You messing me up while I'm talking.
I'm playing with this.
It was fine the way it was, Tom.
There we go. There we go.
I mean, all like purple around us.
How you like that? How you like that map?
Purple. Wait, we need that branded.
Put a question.
There you go, Brandon. There you go, man.
Anyway.
All right.
Yeah, so all across the United States.
But a freebie tidbit, and I tell almost every client this, is if you're looking at a property and you're like, shoot, man, I'm just wondering, is public almost every single county. I've found like 2 in my entire career that we could not find any assessor data, and they were very, very, very small counties. But you can pull up the county assessor property tax card and see what the land to building just ratio is. And yeah, I mean, like you'll see stuff on beachfront that's like 45%, 50% land, and then you'll see stuff that's in the Midwest that's 10%. But I always want to say, like, don't buy a property just because of the tax benefits. But if you're hawing between 2 different properties and one of them's got, one of them has 30% land value and the other one's got 10%, and you think they're both equally good investment opportunities, hey, that might be a deciding factor for sure.
All right, let's hit some of these other questions that are popping up.
All right, so we got
everybody for asking questions, by the way.
All right, we're going to take a question just 1 second, so we'll let everybody know that Rachel will be joining us for a masterclass soon in the Tax Smart Insiders community. So if you do want to check that out, www.taxsmartinvestors.com/insiders. Start your 30-day free trial today, and you'll be able to catch that. And if you can't make it live, it will be available on replay. That's
how many people. How many members do we have now on Tax Smart Insiders? We have like 250 or something, right?
Yeah, something like that. It's 200 and something and counting.
Dude, join the party. We're rolling out new features all the time.
Yeah, we actually got something that I actually just put together today that I'm about to release soon. It's going to revolutionize the course aspect of our of the Tax Smart Insiders group. So you're not going to want to miss that. Having said that, we're going to dive right into this question right here. If I invested in crypto and the platform I use was a scam, is there any way I can write it off? I'm sorry, I read that. I didn't mean to laugh. You might have a casualty loss, right, or something. I'm sorry.
I actually don't know. I don't know how that works. I think that I thought that's how it worked, but because I invested in something called Wonderland. I actually talked about this, I think, on the podcast a year ago, and then that thing like tanked, and $2,000 went out the door. I got Blake, our VP of operations, to invest $2,000 with me, so we were like, "Hey, we're gonna do this together," and then it went to zero. It was not good. So I feel you. I'm right there with you. I don't know if you can write it off though. I think that there's like different rules around it whereas normally you might be able to write something off. I don't know if you can. So I would probably have somebody do some research on that. It's not something we can answer today, I don't think, unless Justin knows off the top of his head.
Yeah, I don't know a definitive answer. I know that the last time that this was kind of being debated is they were like looking into trying to determine like updates on this, and it was partially because there was a lot of like controversy around what was it, FTX was the one.
Mm-hmm.
When that one was going down. So I know that there's continuing developments with that. I think that as of right now that you can't, but that it's because I think it's falling into like a casualty loss kind of scenario, but we'll see. Like I wouldn't be surprised if more like legislation or at least like tax regulation or guidance comes out on that in the next year or so.
All right. So yeah, you're going to want to check that out. Watch out. I'm so tempted to whip out my CFP hat right now. But I'll save that for another time. All right. We're going to go for another question here. We'll be sectioning off a portion of our primary residence and remodeling it to turn into a short-term rental. Would it be most beneficial for tax purposes for us to start and complete the renovation in the same year that it gets placed into service?
That's interesting.
I'm gonna throw that one over to Justin.
Yeah, I'll dive in front of the bus, Tom.
The perfect right now.
That's fine. Yeah, no, I said it's interesting is just like the way that they phrase the question. I like that this is why you should participate in groups like this, is it gets you thinking like, I didn't think about like that aspect. Does that matter? Does it not matter? So it doesn't matter in this particular case, but I'll explain why. So if you are, and this is the case with like any like new property or whatever you're placing into service. So if you, let's just say like in this scenario, you put a whole bunch of money into like, okay, you're like, say we're converting a basement. I'm just going to use that example. They didn't say that here, but I'll just to kind of put an example behind it. Renovating a basement because you're going to rent it out as like, there's 2 bedrooms and a bathroom down there. And you get like the 2 bedrooms done, the bathroom's not done. There's not a good access from outside. So you put all this money into it in 2023, and then you wind up finishing it, like finishing the bathroom, getting a nice, exit down there that people can actually enter through the basement or something. But that doesn't happen until 2024. Well, essentially, we wouldn't consider that to be rent ready until 2024. So the drawback in this scenario, when you're like basically rolling over into like a following tax year, all that work and unfortunately all that money that you put into making all those improvements and updates to like turn those 2 bedrooms into bedrooms, they're not going to be deductible nor depreciable in the 2023 tax year, because it's all about when like that space in the home, or again, this would be the same if you just had like a whole property that you were working on, like you acquired it at the end of the year and it just happened to be you didn't get anything finished until February and you were able to place it in service as a rental up until that point. Because the key factor there is that it's when the property actually gets placed into service, that's when you can begin depreciating it. And also that is the tax year that is going to be applicable to bonus depreciation. So like under the current law, current regulations, in 2024, bonus depreciation is going to be 60%. So not to like rub salt in the wound, but if this is a scenario where you have that portion of the property or whatever that's being placed into service in the following year, it's going to be most likely like limited to that 60% bonus depreciation. But I think that kind of covers all the ins and outs. Sorry, this weird like chunk of light is definitely distracting me over here if anybody's catching that.
No worries. That was an excellent response to a great question. So we got another one coming up here, and I think this is what we covered on the last podcast episode. So we're going to go ahead and jump in here and comment on this. Okay, so if I have a quad and 2 LTRs and 1 STR, assuming the material participation in 7 days or less on the STR, do you believe I would still qualify for the STR loophole on the portion of the structure If no, then does providing substantial services get us there? Okay, so you have a quad and 2 LTRs and one STR. Okay, assuming the 7 days or less on the STR. Long story short, okay, again, we covered this in the last episode of the Tax Smart REI podcast, available on all podcast platforms. You want to go check it out. But the long story short, when you have a multi-unit property, the average period of customer use, or that 7 days or less rule, or even the 30 days or less rule, is going to be calculated based on the entire building, and you have to separate into classes based on daily rent differences. But for the most part, short-term rentals are going to have different daily rents than long-term rentals. So you have to separate them into at least two different classes in most times. You have to run this entire average use calculation. And long story short, in most cases that we've came across, the 2 LTRs are going to raise the average period of customer use way above 7 days and 30 days in most cases. So even if you did provide substantial services on that STR, more likely than not, I'd say most likely, you're not going to be able to use the STR loophole on that quad.
So wait a second. Wait. I didn't realize. I must have not followed you when you were talking about the podcast you guys are doing last week, because that was the podcast that I missed. This is the one that I wanted to talk about. So wait. So why?
I made sure to represent you there.
What's that?
I made sure to represent you there.
Okay. Why do accountants say you can separate out the units on Schedule E?
Because they don't know what they're talking about. Because they've not read the regulations thoroughly enough. Okay, so there's a regulation section. I don't have it off the top of my head, but we do mention it on the podcast, and it's clearly there. Basically, here's how it works, right? Average period of customer use, right? Step 1. If the daily rent differs, you have to break down the property into classes based on the based on the differences in daily rent. Because short-term rentals typically have a different daily rental rate than a long-term rental, hence the reason why you're renting it out on a short-term basis and going through all those hoops, right? You'd separate them out into 2 different classes. Then what you have to do is you have to look at I'm paraphrasing here because the bourbon is hitting me, but you have to look at the gross rental income of the entire property and then the gross rental income of each class, right? And the classes are different based on daily rent. So let me just give you an example. Say you had a duplex, okay? Unit A is a long-term rental, okay? That you rented out for 300 days, okay? Just to be clear, Unit A, long-term rental, 300 days. Unit B, short-term rental, 6 days stay. Now, the entire average, for the sake of this argument, the gross rent receipts from the entire property were $30K. $10K from the long-term rental unit, $20K from the short-term rental unit. So you have to determine the average use factor. So the way you determine the average use factor is by multiple. Okay, I'm just gonna try to explain this. Okay, the paraphrase this with the bourbon. Basically, you're gonna take the 10K of unit A divided by 30K, right? You're gonna get that's 33 1/3. Okay, you're gonna have to multiply that by the average period of customer use on that one unit. Again, it was 300 a day, so you're gonna get 99. That's gonna be the answer. Okay. Then unit B, you're going to take the average period of customer use, which was 6 days, right? And you're going to multiply it by the opposite fraction of that, which is 67.67. You're going to get 4.02. That's what you're going to get. You have to total those two together, right? You're going to get 103.02. And that is greater than 7, and therefore you're going to blow a loophole. And you could find that. Let me find that for everybody.
Can you throw off that most recent comment?
I got you back. It's 1.469-1E3 III Cap C1 is what you're looking for.
And I break it down step by step in my without the bourbon on that podcast, and it was a lot more.
Can you throw up the most recent comment there?
Oh, which one? Sorry. The Math and Bourbon Show. That I would never make it through a math test with bourbon.
So
you did a lot. I mean, dude, you were spitting it out though, man. It's kind of impressive.
So everybody too, that was, I mean, the little the skim across the top detail here too is the idea of like substantial services. And the reason why that particular user was asking about substantial services is if you have an average period of customer use that's 30 days, actually specifically less than 30 days. It's got to be less than 30 days. And you're providing substantial services, then it is also, that's one of the other exceptions of excluding it from rental activity. So that can actually, I'm too on top of it. Here, for those of you that weren't here at the beginning, that's Mr. Old.
He waters it down though. Don't worry. Water in it.
I just make the bottle look brown. So no, I love math. So let's do math and bourbon.
I still don't understand though why, because I see this in other Facebook groups. I've seen it in the Bigger Pockets Facebook group. I've seen it in other tax real estate groups.
Brandon, how many accounting firms do you know that go through and actually read the regulations?
No.
That's the real reason. Wrong.
I'm very aware that all these other, a lot of real estate accountants listen to our stuff and then regurgitate it.
And
so I understand that, but still, like,
you know,
but still, like, and that's not like, you know, don't get me wrong. I think that we are the best, but at the same time, I don't know. I just think that I just see a lot of people regurgitate our stuff. They even do that with our deliverable. It's hilarious. Anyway, that's beside the point. But I keep seeing there's a couple accountants that keep saying you can split it all out, and I was always like, I don't know if that's the right thing. So I'm glad you guys clarified that. I might actually have to go listen to our own podcast. It'll be like the second episode that I've ever actually played back.
That's great. It'll add to our downloads.
And I have to give Justin a lot of credit, because Justin always brings the fire to the podcast every single time. Every single episode that Justin's on, it's always like, you know, he brings the heat. Okay.
I like the weird stuff. What can I say? But yeah, I mean, I think why a lot of them look at it is it's really, really easy to provide the answer that the client wants, right? We've all been in that scenario before, and I'll hype up our firm big time because integrity is like at the top of our priority list. And that's why we do so much research and why we cite everything. But it's on the tax preparer side, I hate to say this, but there's not very much liability. You know, and I think Tom actually mentioned that in one of these previous episodes of the podcast, is that, you know, for the most part, the tax preparer, we don't have a whole lot of exposure as far as like misrepresenting something. If we know that, hey, this is egregious or this is erroneous for sure, yeah, we can get penalized. But at the end of the day, unfortunately, like the person that winds up holding the bill is the taxpayer. And not to put like other like tax preparers down, but I think that to some degree, they're probably not super worried about it in a lot of cases because they're not the ones that have the liability. You guys are as the client, like as the tax preparer, as the taxpayer is what I meant to say. So you see, there you go. There's bourbon kicking in. You know, that's why you gotta have like a little bit of extra diligence there, is making sure, like asking the tax preparer, like, hey, why do you know that this is fine?
Well, it's funny because in these different like groups where I see this conversation happening, it's always the same like 2 or 3 people too. They always say, yeah, you can put the short-term rental unit on Schedule E, and that can be separate from the long-term rental unit also on Schedule E. And I've never said anything, but nobody ever asked them for a citation. Nobody ever asked them to explain. So maybe that's a good point, dude. Like next time you're on one of these Facebook groups, just ask, like, do you have a citation for that? Because I would actually just be curious to know where they're getting this information. Like that's what I kept challenging. So Justin, Tom, and I had this big internal debate, and it wasn't like really a debate. It was just me asking consistently, like, yeah, but take the other side of the argument. What would they be citing?
Right?
But then we couldn't find anything. So it was just interesting. That whole concept is just interesting.
I mean,
yeah. And there's also, so like we have like the 1469-1 that basically points towards it, but there's also a lot of other code sections that allude to this too, like section 168, where we're dealing with all things depreciation related. They touch on this in that particular code section as well, as far as like what happens when you have one building that has multiple different types of uses. Like what happens when you have a like commercial. This is very applicable. You have commercial on the bottom, residential on the top, right? Where you've got something like retail on the bottom floor, again, densely kind of urban area, and then you've got like loft apartments that are above.
Right.
So again, like a little bit, I mean, we're talking about a little bit of apples and oranges, but it's clear that the IRS, when applying all the stuff to the code, they were thinking things through when they said, we know that these types of situations are going to happen where there's mixed use properties. So if they did that with depreciation regulations, why wouldn't they also do it with long-term versus short-term regulations?
Right. I mean, you got to look at a building in New York City. There's so many mixed-use buildings in New York City that has like anything you could possibly imagine in one building. You know what I mean?
Right. So why wouldn't they write the regulations to address those situations?
Right. What's the 7-day or less regulation section? 469 what? 4? 3?
Yeah, it's 469
1T328. Right.
3.
1T 1E.
Oh, you're looking for
it's 1.469 1-TE3 double I cap A.
Yeah. Put up where's the citation that shows Schedule E versus Schedule C? Let's just like walk through this.
Okay, that citation.
No. Put that question up. I've already got it all.
Okay. Brandon's ready to fire.
Yeah, dude, I'm ready. All right. So can you share my screen?
Oh, share your screen. Okay.
Yeah, man. Okay. So the reason that everybody gets confused. So this is the regulation section to 469. So regulations are not code sections, right? So the Internal Revenue Code would be section 469. The regulation is, think of it as like an explainer to the code section, right? Yeah. So that's what this is. Whenever you see a 1 point section number, that's you know you're in the regulations, especially if you see like a dash something after that. So regulations will expand on things. So the question is, what is the definition of a rental activity? And instead of defining what a rental activity is, they say except as otherwise provided. Exceptions to the rental activities are the average period of customer use is 7 days or less. So this is where the loophole exists, right? So and that's why we always say like it's always fascinating to us when accountants say this is like a scam or it doesn't work or whatever, because it's literally right there. Right. If the average period of customer use is 7 days or less, then it's not a rental activity. And if it's not a rental activity, then C7, then you don't have to qualify as a real estate professional, because this is the real estate professional status section right here. And it says shall not apply to any rental real estate activity, right? So if I don't have a rental real estate activity, I don't have to worry about it. So that first off, that's where we get the short-term rentals are not a rental activity. But what happens is when people read this exception, sorry, where I'm at, this exception, they think that because the average period of customer use is 7 days or less, and because it's not a rental activity, then it must not go on Schedule E. But the important thing to understand is that Section 469 is just a code section. It doesn't necessarily dictate where we report the activity. We have to look at Section 1402. Section 1402 is where we get the definition of net earnings from self-employment. And you can see right here, there should be excluded rentals from rental real estate. And then it says, unless you are a real estate dealer somewhere in here. Bourbon is also hitting me. But somewhere in here, it basically says, unless you're a real estate dealer, then you exclude rents from rental real estate from the definition of net earnings from self-employment. And so then the question just becomes, well, what form do you report it on? Because if I don't have net earnings from self-employment, then I'm not going to report it on Schedule C. I'm just going to report it on Schedule E. Because if I did report it on Schedule C, then I would have net earnings from self-employment. That's where you report self-employment activities. And if you're still like, well, okay, this all sounds fine and dandy, but like, give me more proof. I have the CCA. This is the most recent CCA. This is a memorandum that the IRS put out on November 19th, 2021. I will actually paste the link to this into our Facebook group on this.
And for you guys wondering, Office of the Chief Counsel up there at the top, that's essentially the IRS's attorney.
Yes, thank you for and there you go, and you can see like exactly who did it. But I would recommend just kind of going through here because it basically says everything that we just told you. You can see 1402A1. That's that exclusion from self-employment. You can see it referencing a little bit further down here, Section 469, the Treasury regulations to Section 469. There's that. This right here is this right 2A. 2A. So this has a whole analysis for you that you can read, and it talks about providing services to your tenants and when those services would subject you to self-employment activities versus not. So anyway, it's out there, but and it might be a little more like legal jargon. If you're not used to reading this stuff, it might be a little confusing. But I highly do recommend go read through it because it's interesting. I mean, they talk about Wi-Fi services, right? So it can give you a really good idea as to what will potentially cross you over that threshold of providing substantial services to your guests. And that's what this whole thing is about. If you provide substantial services to your guests, now you do have a Schedule C activity. You are subject to self-employment taxes. So that's why we say, hey, you don't have a Schedule C activity unless you provide substantial services to your guests. But this Chief Counsel memorandum will tell you or kind of give you some clarity on what do those substantial services look like. So I hope that helps. That's a really good question. Yeah, just I hope that helps you.
All right, so we're over the hour here. Do we want to wrap up with any final questions?
Yeah, somebody had one out there or something. We could do like one or two.
Okay. Okay, so let's see. Requires substantial services. Doesn't matter the length of the stay. I want to cover this one. I think we can cover this one real quick. The short-term rental, it requires substantial service. Does it matter the length of the stay? Yes, it does. It definitely does. What if the stay is 7 days and no substantial service? Okay, look, here's the deal. I'm going to break this down really quickly, as quickly as possible, right? 7 days or less, no substantial services. Goes on Schedule E, qualifies for the short-term rental loophole. If you materially participate, losses are non-passive, okay? If the average stay is above 7, is between 0, okay, actually between 1 and 30 days, and you provide substantial services, then it also qualifies for the short-term rental loophole. You do not need to provide substantial services if it's 7 days or less, okay? Did I cover everything there?
But in that scenario, if you're providing substantial services, you're reporting it on Schedule C.
Right. Okay, yeah. Exactly. If you're providing substantial services, Schedule C. That's the moral of the story, guys. Okay. Everybody's listening. Everybody's tuning in, ladies and gentlemen. Moral of the story: substantial services, 30 days or less. It's going on Schedule C. Okay. No substantial services. It's not going on Schedule E. Okay. Period. End of story. You're right. Several CPAs have written that verbatim. Well, you should get that relooked at. And I think he said he was.
Yeah, check out those citations.
Actually, hey, if you have one of those like tax plans that cite that or that tell you that stuff, we'd love to see it. Because again, I would love to know what they are, what code section, what tax court case, what regulations they're citing that gives them the comfort to take the position that you can break out your units. We don't think it's possible, but I'd love to see if you have that, what that looks like.
Sure.
All right. Market's lower depreciation condo purchase overcomes setback. I think this is an interesting question. A lot of people ask this question about condos, right? Condos and land improvement specifically, right?
Like land value and condos.
Land value and condos. And I think a lot of people have the same question. I've spoken to cost segregation specialists about this. It depends on what's carved out in the exact agreements, of what you own in the condos. But depending on where you are located, you might not have any land value. And then the condo is mainly structural and 5-year property, also known as tangible personal property, which is eligible for bonus depreciation. So I think it depends, right? It depends. I mean, you really have to speak to a cost segregation specialist about your specific property. It's hard to say.
Yeah, and it depends a little bit on I hate to say it, but like how knowledgeable the local assessor is as well. Because we do see condos regularly that are assessed with land value. And I would say that those ones are the more savvy of the group, because there is there is court case precedence for this as well. Don't have the names off the top of my head, but even in a condo scenario, you should have land value. However, I will say I'm seeing, and I'm convinced a little bit in the market, it's my suspicion here, there are more and more developers that are becoming somewhat savvy of this particular type of feature. Is more of them are starting to structure these deals where there is a land lease involved, and the land lease is being leased to the condo structure itself. And then the condo association is the one that's paying the land lease. Now, I would say like there's a pretty darn good kind of argument for that of, okay, yeah, the condos, every single one of these condo owners does not own any of the land. They're literally leasing the land from some kind of landlord. And there's a lot of precedence for that in commercial real estate. So, if you're dealing with a situation like that, I would say you could theoretically have zero value in land. I've even seen like single family homes and housing developments that are being structured that way as well. But if there's not any kind of land lease kind of structure involved, and you are like buying a condo, there should be some amount of land value actually being attributed to the condos.
100%. So, okay. So we're going to wrap this up with one last question here, or one last take. And then I have one thing to wrap it up. And then I think we're good, unless anybody.
And if you're watching right now, you should watch the first 2 to 5 minutes of this, because Tom gave everybody a gift. So
yeah. Yep, you get the short-term rental tax course for free. Okay, in case you missed it, I'm gonna give it to you right now. Okay, if you're still here. Okay, you get the short-term rental tax course for free if you go to www.taxsmartinvestors.com/free short-term rental tax course. You get it for free. Okay. The last thing that I have to say is this. Okay. On this mixed-use building, yes, if you have a mixed-use building, more likely than not, if you have a mixed-use building, more likely than not, unless all the units are going to be short-term rentals, it will most likely have an average stay above 7 days. And we've tested that, and we've seen that time and time again. And that's pretty much it. So
sorry, Tom, I've got to jump in here just because this is so juicy. So I saw one of the last comments that came in was, I'm going to send you guys documentation, put up by a tax advisor who's a prior IRS auditor, right? Like we said before, love to see that, love to see documentation citations. Just for full-blown reference, there have been former IRS agents who have been audited and argued their cases in tax court and lost their arguments in tax court. So just the precedence that they are a former IRS agent does not necessarily make them a full-blown authority, but we welcome the information, 100%.
Please send it. I would love to see it.
Yeah, please send it.
Yeah, and last but not least, look, in all seriousness, bringing it back down to reality here. Look, if you're working with a CPA, you're unsure, you don't know if they know what they're talking about. You want a real estate specialist who knows the short-term rentals stuff inside and out. Okay, you come visit us at www.therealestatecpa.com. Click the Get Started button, request initial consultation. We'd love to learn more about your situation and see how we can help. So having said that, thank you everybody for joining. And again, we'll be back at some point in probably next month with another episode of Taxes and Bourbon. And I'm going live every Wednesday at 1 p.m. Eastern with various tax strategies and tips. So I'll catch you then. Thanks again for joining.